stock market isn't doing that great. In the past few days, we see more red than green. And I think it hit the Nasdaq market quite seriously. We're talking about like 10% drop in just a couple of, maybe just few weeks, right? So I'll show more details on my portfolio and then we'll go from there. So this is my current portfolio. So for those who are new to my channel, this is my portfolio. I talk about my portfolio all the time. And right now I've created a bot. If you are in my Telegram group and you just do a prompt and then you can see my portfolio on real-time basis. Okay, just to give you some idea that whenever I talk about like my portfolio drop, right, this is because these are the compositions. It's quite heavy on tech. We have names like, like NVIDIA, TSMC, Amazon, Microsoft, Apple. So when Nasdaq market drop, my portfolio also got affected. Okay, this is QQQ changes over the past 1 month. We can see that it peaked around first week of July and then subsequent weeks, it's already dropped more than 10%. So if you read the news, right, they will say that, oh, Nasdaq is currently in bear market. But just bear in mind, bear market is only 10% drop. In certain years, the drop is a lot more than just 10%, right? Because we don't have this kind of 10% drop on like every month. So when it happened, it still caught us by surprise. This is my portfolio. So starting about 1 month ago, it was still doing quite well. I think it peaked around, here's the number, it peaked around 858,000. Just in the recent Friday close, right, my portfolio already dropped to 728,000. So this is like 130,000 drop. We are talking about in 2 to 3 weeks. It is like, many months of my salary already is already gone. But I think this is not something that is surprising because stock market is always volatile. We just need to learn how to withstand this kind of volatility. I know some of you, you may just started your portfolio. Maybe it's like, like 50,000, 100,000, some are 500,000, some are even in the millions, right? So this kind of volatility will go up as your portfolio grow larger. We are all in this process of learning. So just be patient about all this volatility. As long as the economy long-term is doing well, don't be too worried about the short-term fluctuation. Okay, this is the fear and greed index. You can see that right now we are already at fear zone and it's quite close to extreme fear area already. So it changed quite a fair bit. You see that early this year, right? You see these January figures here. It was still at 75th percentile. So it's still quite high, meaning that people are bullish about the market. They feel the greed, right? They feel that they need to get exposure into AI stocks and so on. Then we're talking about just a couple of days, it just dropped from 50 to now it's at 25 already. So market can swing a lot within short period of time. This is again, I would say again and again, right? This is nothing new. You see at late last year also, October is like close to around extreme fear level. Then suddenly just a couple of news, market turn green and then people feel greedy again. So this is the market that we are in, right? It's always oscillating and fluctuating between extreme greed and extreme fear. The questions now is that I know some of you tune in just want to listen to me like, okay, what's going on with the market now? Now, since Nasdaq dropped 10%, it's getting cheap now. Should we buy now? I mean, these type of questions. I do get some questions quite often, and I myself also, when I reading news, looking at data also, I try to figure out that, okay, where's our current positions? Is this cheap enough to, like go in big, or is it still, expensive? So I will pull through, like a couple of charts that I shown in the past just to set the context of where's the market valuations at the moment. Sometimes, our feeling, right, our emotional, just because we see a huge rate, right, then we think that market is cheap. But sometimes it is not the case, right? So here, I'll pull out a few charts here. The first one, right, back to this Buffett indicator model again. So this is, for those who are new, right, this is just comparing the size of the economy or the GDP versus the total stock market cap. If this thing operate normally, we should expect that stock market going up over time. At the same time, GDP also going up over time. But when you take these two variable, right, the total market cap divided by the GDP, it is not something that is like a constant. Sometimes the stock market went above the GDP, sometimes it went below. I'm talking about the ratio now. So in this chart here, you can see that there's this historical average marked by this gray line here, gray dotted line. But sometimes it is like 1 standard deviations, or sometimes it's 2 standard deviations above, and sometimes it's below, right? So you can see that during period, for example, like dot-com bubble around 2000, it gets very overvalued. And then after the GFC crash, you can see that it is like, even like more than one standard deviations below the historical trend line. So you can use this as a proxy to say, is it market, is it cheap now? So if you look at the level currently we are in, right, we are still in overvalued market. Although market is already like cool down a bit, drop slightly, but still it is not cheap. Okay, but this is talking about S&P 500 now, only looking at US. So if you plot the same chart for Nasdaq, maybe you can get slightly different picture, but I'll guess it's still at overvalued because Nasdaq is already having a huge run over the past 1 year. Now it just like cool down a little bit. Then the second one is price over earnings model. So this is very simple. Basically, we are comparing the price level. You can call it like the market cap, right? Versus the earnings of the companies within the index. When the PE is high, of course it is overvalued, and PE is low, it's undervalued. Right now, we are still at about like 1.5 standard deviations overvalued. So still not cheap. But of course, if you compare to the previous period, say for example, about 2021 is even more overvalued. And if you look at the dot-com bubble, which is about year 2000s, right, it is a lot more overvalued. So you just look at the range here, right? We are still over the high sides, but it's not super overvalued at the moment. At least it's not as expensive as 2021. So just keep this in mind. This is PE. And then the third one is interest rate model. This is basically what they try to say here is that we shouldn't look at stock market on a standalone basis. We should also look at the bond market and comparing the interest rate versus the stock market. So let's say currently, right, because the bond market yield is still quite high relative to zero interest rate environment. So if you compare stock market versus bond, currently is still on the overvalued side. It's about slightly more than one standard deviations. So this is mainly because the yield is still high. Let's say if yield continue to come down, right? Comparing bond market versus stock market, you might think that, okay, now as yield coming down, the stock market will become relatively more attractive and it will start to come down as well. So, but now it is still not the case, right? Because we know that interest rate drop will come soon, but how soon it is still yet to see. Later we'll look at the Fed fund rate projection, but here we are comparing against the 10-year. Basically, if you are neutral between stock market versus the bond market, right now is still, the bond market is still on the favorable side just because of the yield level is a lot higher. Just a few years ago, right, let's say around 2020, the 10-year yield is super low. If you are in that environment, it doesn't really make sense to buy, like bond. Just because the yield is too low, might as well just put your money in stock market, right? So that was the environment. But now, because the yield is high, you are basically paid while waiting, So, and we don't know where's the direction of the economy, right? There are some signs that pointing towards a weakening of the economy. We'll go into some of the headlines later. Okay, so these three models, right, just point towards to say that actually no, the market is still not cheap at the moment. Still not cheap. But should we, stay out from the stock market entirely just because of all these indicators say that it is still overvalued? I won't say that is recommended as well, because sometimes while we are waiting and let's say the economy just have a small dip and then come back on again, and you are late to catch up to that, right? So you will just lose out the rally, because we all know that stock market over the long period of time is still go up, because all these businesses, they are still making money, they are still generating cash flow, and their earnings tend to go up over time. So if you stay away from the market for too long, that's the risk that you are taking. Just bear in mind with that. So I would rather to be a permanent, like a perma bull than a perma bear by just looking at all these charts. But for those who think that, okay, market looks attractive now and you want to get in, I would suggest that don't, do extreme market timing from no exposure to like full exposure right away. We all should take the pace and then just execute your strategy on a consistent basis. If you are doing DCA, do the periodic DCA as usual. That should be the recommended approach. Not to say that just because 10% drop in Nasdaq, then you go all in already. Because the moment you go all in, if further drop by another 5%, you also feel extremely painful, right? So I think the DCA really helped from emotional point of view. Then there's a new one that just popped up, right? This SAM rule. I think this is not the popular metrics that people look at, but just recently, because I think they cross certain threshold, and then we start to see people talking on X that this SAM rule is, kind of like predicting there's a recession risk. For those who don't know what is SAM rule, actually I'm also like I'm not familiar with this, but I look at the description here, right? It says that same rule measure the current 3 months moving average of unemployment compared to the prior 12 months low of the same stat. So if you see that there's this two lines here, if we cross over the orange line, right, what it means is that the risk of recessions become super high. So this is basically predicting whether the economy is still going strong or is it like getting weaker. You can see there's already quite a significant jump here. I'm not sure whether this chart is like fully updated, but of course all these threshold, right, if you read different literature, maybe they are using somewhat different threshold. So don't take this as like a definite line. Just look at the trend, and just from the trend alone we can see that all this unemployment, the job creations is already slowed down. So it is pointing towards weakening of the economy. So just bear that in mind, because whenever we are having exposure in stock market, and let's say if really we are entering recessions, right, things will really get ugly, and we all, like, you having exposure, you just need to be prepared now. This is one data point to look at. I think this is the headlines that caused the huge drop on Friday. So it says that US hiring fell sharply in July, and unexpected setback for the economy, stoking recession fear. So you can see, right, there are two things that the economy is worried about. The first one is, of course, the strength of the economy. Usually we are looking at GDP growth, we are looking at PMI, we are looking at job creation, we are looking at the consumer spending. So this is the growth part. The other part is that the inflation. So we want low inflation and we want high growth. So now it seems that the inflation side is doing okay, it's slowing down. I think Jerome Powell also talked about like cutting interest rate soon. I think on the inflation side we are fine, we are doing okay. The problem now is on the growth side, where you see all these job creations is slowing down, kind of like shows signs of some, signs of recession. I don't know whether it will come or not. I think many people are doing all these predictions. Even around late last year, people are talking about recession for so long, but it didn't happen. So I don't think we should, pay too much attention to predict recession, but at least we need to look at this. Because if you don't pay attention to this, right, say market suddenly drop by 10%, 15%, you still don't know why the market dropped, right? But if you pay attention to this, you know that yes, we acknowledge that stock market dropped because things are getting uglier. Recessions is coming, or we are already in the recessions. Once that happens, right, you can see that all the corporate numbers will deteriorate as well. So this is something to just bear in mind. Now, talking about the interest rate. So interest rate, this is the Fed fund rates projection. I won't say it's projections. This is the market implied level of Fed fund rates. We are currently at this level here, 525 to 550 basis points. So I think the market is projecting or implying that there will be one rate cut in September with about 78% probability. And then there's actually 22% probability that we might get a 50 basis point cut. I don't think we will, is that drastic, because now inflation is still not like, below 2%, right? So I don't think it will be that drastic. The 25 basis point cut, I think it will happen. And market, I think always they have a strong opinion that interest rate will keep on going down over the next until first half of next year. But this part, right, the first half of next year, this part is a part that I am a bit skeptical, because we really need to see that the inflation keep on coming down and coming down hard to see this kind of drop. But right now, I am still not too sure. Sometimes, economy weakening doesn't mean inflation will just go away. It's too simplistic to view it that way. So I'm still skeptical, but I think from now until the end of the year, I think we should be expecting to see, let's say, 1 or 2 cuts. So this is the market projection right now. Okay, so what's the headline, right? One headline, just want to share that Buffett just disclosed in the financials. Buffett just sold almost half of Apple positions. I think this is quite big. I think they raised their cash to now, if not mistaken, about 278 billion of cash pile. Actually, I am quite curious what he tried to do with those cash. But I think Monday you will see that some movement on Apple stocks, because I think this is like a huge, position changes from Berkshire Hathaway. So they really sold quite a big stake. I think that's all on my slides. So right now, I will just quickly go to Slido. First, I will just give a shout out to Web, who is posting quite a number of great questions. I need to think through those questions before I answer. So I did some preparations I wrote on my Substack. So I'll put a link in the descriptions. If you are curious on what are the questions that asked by Web, you can just read the Substack there. I won't go through go into that details of questions that asked by web because I think it's like 6 or 7 of questions there, quite a long list. I'll go through the other questions on the side page here. So the first question is, can you give your opinion on recent Amazon Q2 earnings given that they gave a softer guidance despite AWS beating expectations? So I will just break down these questions to two parts. The first part is that their actual result in Q2, which I think is great. The result, I'm quite pleased with Amazon result. I think whatever that they said, right, in the past, they said they are going to cut costs. They said they are going to, make their logistic better. So you can still see there's an improvement on the e-commerce logistic cost saving effort and so on. So we are still seeing improvement there. At the same time, on AWS side, right, they say that all the cost optimizations by their customer is already done. I think they iterate this for I think at least 2 or 3 quarters already. We still see improvement there, meaning that instead of keep cutting costs, now AWS consumer or customer is already deploying new workloads. So I think this one from growth perspective, right, is really looking well. I think it's looking good. All good picture up to Q2. About the softer guidance, sometimes I think analysts, right, they will really extrapolate all this picture on the guidance side, right. I will at least I won't pay too much attention to that at the moment, because I think sometimes if you are reading too much into it, right, they might just pull out earnings and revenue growth beat, right, in next quarter. Who knows, right? So on the future outlook, I will just pay more attention to the things that they're working on, and then see, based on those, see whether there's any traction or not. So far, I think for AWS, they are still doing okay. I don't think they are running as fantastic as, a couple of years back where they are growing at 30 or almost 40%. Now we are not at that kind of high growth, but to say that it is slowing down, this AWS things is dying down or is showing zero growth, I don't think they're heading that direction either. I think it will be something about 10-ish% kind of growth. I think the more important is not the level of growth. It's we are talking about, let's say, 10 or 15%. Can this kind of growth sustain for another 5 years or longer, right? I think this is the questions that I pay more attention to. That's why I will say that I don't think the huge drop in Amazon stock price after the earnings release is justified. I don't think their situation is that bad. Okay, that's just my high level feeling when I read through all the transcript and earnings. While we are with Amazon, just quickly look through some of the interesting details that I pay attention to. So I think just few years back, right, we're not talking about that long ago. You look at this Q1 2023, right, we are now at Q2 2024. It's just 5 quarters ago. People are still saying that, the e-commerce is not making money, the operating margin is negative, the entire company is only the AWS side that is earning. I think back then I make some comment on Amazon, and I say that actually for the e-commerce, I don't think this can be a 20% margin kind of business. It is a low margin business. Okay, it's just that it is not as low as 0%. I was thinking that, okay, maybe we are talking about 5%, 7%, maybe up to 10% kind of margin that they are able to command once they sort out their logistic, they sort out their cost structure and so on. So now you see we are already at 5.6%, still a minor improvement compared to previous quarter. We're talking about this 5.6% over a huge sales number. It is 90 billion sales in just one quarter. Maybe I don't know those who are let's say your favorite companies, right? You can look at their revenue. How many of them have this kind of revenue? Quite a number of companies don't even have 90 billion revenue in a year. Just the retail business of Amazon, right? They are already 90 billions, and this one is also growing. You see that the top line is still growing at 9%. So I'm quite pleased with their retail e-commerce business. And then if you just look at their international segment, right, it used to be making a lot huge, quite significant losses 5 quarters ago, and then we can see that the improvement came, right? 6.5 become 5.6, 3.6, then 2%. These are all negative numbers. That means they are making losses. But this one is aggregate of all the international. But if you look into the international segment, right, there are markets that are making money, but there are newer markets that are still making losses. But they are still investing in those new markets. You can see that there's improvement here. And last quarter, we see that almost break even. And this quarter, we see that it's already positive. If they are executing well, right, this 0.5%, I won't be surprised if we're just going up to, 1%, 2%. I don't think it will be as high as US market. Let's say we're talking about 2-3% is definitely something that they can achieve. And again, their revenue is not small, right? You see 30 billions in one quarter, we're talking about 120 billion. Just 1% increase in the operating margin, that's 1 billion plus earnings in a year. So these are not small numbers. And then of course, the AWS segment, you can see that now it's already more than 100 billions run rate in terms of their revenue. And still they are growing at 19%, right? I think it's not that bad. And you can see that it's already picking up from those period where they say there's a lot of cost optimization on their customer. So they were growing at 12%. People think that AWS is dying. And then now suddenly pick up to 13, 17, now at 19%. So this is definitely good picture, right? So that's why I say if you just look at what the actual numbers, the Q2 numbers, it's really, really good. I mean, outlook-wise, there are many factors affecting that, right? So let's look at the number when they came. And margin-wise, I also think that is okay. It's at 33%. So it's a decent pickup, right? So I think it's a good picture here. I don't know whether you guys can hear the background noise or not. With kids at home, it's always noisy. I'll come back to the questions here. Do you think TSMC is still undervalued? I think TSMC is fairly valued at the moment. I haven't really update my DCF and I can't say it for sure. But one thing to note is that right now we are at what we call the CAPEX cycle, meaning that quite a number of companies actually spending huge amount of money in all these different like let's say for AI chips and so on, right? So they're spending a lot of all these CAPEX, and definitely TSMC is benefiting. We don't know how long can this last. The moment all these GPU sales come down, right, TSMC business will be affected. So this semicons industry is always cyclical, and given that now we are in up cycle, right, for those who want to invest now, I think feel free to do so. You just build your positions. If you're investing in a cyclical business, you just need to be prepared that whenever the cycle turn, right, when the financials get ugly, the stock price can get ugly quite fast. So we all experienced this in the past. I'm just thinking that if I'm going to add to my positions, which is already one of my top positions, right, I would prefer to add into the positions when the market have some level of panic that is more than what we are experiencing now. That's why I'm not adding on TSMC now. I think I have quite a decent positions already. And I'm still watching. I still have a decent stake there. But if you want to add, maybe do it a bit early rather than, wait until really, because right now we are up cycle, right? We are not at peak yet. You don't know when it turns. But if you wait a while and then only you get in, maybe from that point onwards, right, the chances of it turn soon after you bought is even higher, right? So I think that's my feel. But I would say that, let's say if you just want to build a small positions, just feel free to do it. Don't just all in on all these cyclical stocks just because you haven't looked at the entire cycle, right? So just pay attention, have some exposure, watch the cycle. That really helps you to form opinions on this entire semicon industry and cycle. So I think that's quite helpful. If you have a crystal ball and today is the bottom after market crash, what stock will you all in with highest conviction? Actually, if I have a crystal ball and I know the market just bottom, right, I wouldn't focus too much about which stocks to all in. I'll just buy the market and just leverage up 10x, right? So that's the easiest way to make money. But of course, first thing is that we don't have a crystal ball. So this is a hypothetical questions that we can't really make use of it. Then the second question is that, okay, let's say if we know that now market is bottom, but sometimes don't just look in at market as one thing, because if you look into the market, right, you can see that, okay, different industry, they are having some different kind of cycle, okay? Sometimes it's like, the broad market is bottoming. It's possible that at the same time, right, some market is, having a good time. So I think you just need to look into the different details if you want to, take opportunities of different things. Sometimes in certain environment it's more favorable to commodities. Some, like I mentioned, the semicon cycle also up and down. It might not be exactly the same as the overall economy, right? So if your question is which one to get into, my suggestion is that you need to go at least few layer below, looking at different sector, and then even for the same sector, you want to pick the companies that you like the most and so on. And all this just require a lot of works to have that kind of insights to make full advantage of the opportunities. So I think that one really, you whatever that you buy, right, will be the one that you study the most, because it's easier to pull the trigger, right? Because you know the companies, you know the sector. If you don't know, you just think that the broad market is bottoming. I think that one you can't take the maximum opportunities there. Okay, next question. If you start buying, what stock will you look into it after these corrections? I think I've answered this. It's the same as my previous questions. For me, it's quite easy. If I want to, like go in big, right, it will be one of my positions because I have studied them, right? So it's a lot easier. Even if, let's say, the stock price drop after I buy, at least I can interpret. I know why it is dropping, right? Instead of like, oh, market drop, then I feel very painful. I don't know why it is dropping. I think that market is betraying me. That kind of feeling. If you don't know, you will have that kind of feeling. But if you know what you are doing, right, you have studied enough. Even if a market experience some level of drop, you're still able to assess it objectively. So that's the state that we try to be in, right? Okay, next one. Given the high unemployment, are we near the bottom or there is more pain to come if Fed doesn't cut interest rate by 0.5 basis point in September? By the way, it's 25 or 55 basis point, not 0.5 basis point. Right now, we are not at high unemployment, okay? Current unemployment rate is still doing okay. It's just that the pace of job creations has slowed down. But of course, these things is like a trend, right? Once it's trending towards like less job creation, then of course, if there's retrenchment, there's layoff, of course, all these employment number will get bad, right? So I think that's something to pay attention to. The questions now is that if that happen, right? Basically, two things we are watching. How ugly on the economy side, meaning that is the layoff continue to worsen over time, and then when that happen, right, we should expect to see the rate cut from the Fed, and we don't know how aggressive is the rate cut because for example, like, let's say really the unemployment rates just shoot up, right? Let's say shoot up by 3%. Then suddenly Fed just like cut rate to zero and then do a massive QE. Like if it is aggressive actions from the Fed, of course market will go back to rally again, right? We don't know all these things whether it will be true or not because you need to remember that when Fed do that kind of actions, they always have one eye on the inflation. You need the inflation to calm down enough for them to do an aggressive monetary policy, meaning cut rate aggressively. If the inflation still sticky, for example, still hovering around 3%, not coming down, I think they will do some cut, but it will be just a minor cut. And if that happen, right, let's say if they just do a 25 or 50 basis point cut and then just stay there, and then on the other side, the job creation, the unemployment rate just keep on deteriorating month after month, right? Then the stock market can really just, down a lot. So I won't be surprised, That's why I say it's very hard because people make up all sorts of story by just looking at one angle, which is, let's say, just the inflation alone or just the Fed alone. But this entire thing is like they all have the macro side. You have the inflation, you have the GDP, you have the job. So all these things, when they mix up together, what kind of actions that the Fed will pull out also is uncertain, right? So that's why it is so complex that it's very hard to make any predictions. My sense is that we all just need to know what are the things that drive the market and just position in a way that we are comfortable. Sometimes when you feel that things are shaky and you just want to build some cash. I think that's the only things that we help us in the management of our portfolio. To predict is totally different things. It's so hard. I've seen that even those legendary investors also keep on getting it wrong, right? So who are we to do this kind of predictions? We'll be adding more NVIDIA. The forward PE is starting to look attractive. Why do you think NVIDIA is trading at such high volatility during the past week? I think this one, sometimes, when the price keep getting higher and higher, you don't know they are attracting what kind of investor. I would argue that, yes, like the long-term investor like myself, right, we held it all the way, like even now it's like, 600% gain, I'm still holding it, right? So these are the long-term investors, they are in it for long game. When it is showing a high momentum, right, I won't be surprised even all the traders, all the new investor, the meme traders, they all jump in and just ride on it, right? And this type of traders, right, they always get in with stop loss. Meaning that, let's say they set a stop loss at, let's say, 20 days moving average or whatever, right? So they will keep on riding, and as and when more and more people riding on the stocks, right, the share price will go up. And the moment it turn, right, it will be same group of traders that's either liquidated or getting out or cash in for a profit and just run away, right? And that's why all these technical charts, when it happens, it will have a huge volatility just because the previous run is already like quite a huge run. So that's something to pay attention true. Okay, that's like, although we don't do the trading, there are other traders that are affecting the share price. So that's why I would say that all this volatility is just part of the game. Okay, that's why I'm not like saying that, oh, just because the share price is up, so I'm adding more. To me, it's like sometimes it's already overvalued. It can still get more overvalued because of all this activity. Okay, that's first point, the price actions and affecting by all the traders there. Then the second one is that, will I buy now? No, I haven't. Actually, the last time I bought into NVIDIA was 2022. Okay, I really didn't, like added in the past 2 years already. Okay, to me, my current positions is about 20% is enough, and I am always skeptical in terms of like how long this revenue growth rate will run. I know that for these coming quarters, right, which is they will release their earnings in, I think soon, end of the month or third week of the month. So I think they will do well there, no problem. I'm not afraid of their sales trajectory until end of this year. But whether this can last until, let's say, early next year, whether this can last until end of next year, and whether the revenue growth rate will be as high or higher than the analyst estimate, all these are still question mark, because we still need to see that all this GPU bought by all the hyperscalers and all the customers, right, are they able to turn all this into profit? They have to use all this GPU to create solutions, create services that is generating like decent amount of revenue. Then only they have the flywheel to take the earnings and buy more GPU and keep this thing turning, right? So that part is a bit questionable for me. I think it's like, the question is, yes, they are generating revenue. The question is always like, is it high enough or not? So I myself also skeptical. I know that the company is a great company. The type of offerings that they have is like the best. I don't think, let's say, AMD with their AI offerings is close to NVIDIA. I think they are the best, okay? But doesn't mean that just because this is a high quality companies, then their revenue can just keep on going up and up and up, right? So that's the skeptical part of me. That's why I still like, just have the positions, just write on it, but I'm not adding at the moment. But let's say, right, of course we are comparing two things, right? One is all the fundamentals, meaning their revenue, their margin. This is on one hand. On the other hand, we are also looking at their prices, right? Say, for example, if they are able to execute well and their revenue keep on going up for another few quarters, is like, significantly higher compared to today's level. And let's say the price drop by 30%, right? It might hit a level that I think that is attractive to get in. Then, of course, I might add in the future. I'm not saying no entirely, right? So we need to pay attention to two different things, the pricing side and also the fundamental side. That's my comment on NVIDIA. Will be adding any specific stock or ETF given that QQQ has headed into correction territory? I think this is what I mentioned before. This year, I think whenever it comes to buying, right, I will just pay more attention to ETF, because I think I'm quite happy with my portfolio mix. There's no positions that I think I want to add significantly compared to my current sizing, right? So I will pay attention to ETF, and I won't just go into like broad-based ETF. Right? I will just get into like those tech-focused one, for example, like QQQ. So because I know all these tech companies more than the other industry, right? So I still think that I can add more into like all these ETF that's heavier on tech. So QQQ will be one, or those that is related to tech. Top 5 shopping list. Again, my shopping list is always my current portfolio, because I don't do like I already have this and I need to keep on buying something else. I'm not like that. I see that my current portfolio is just like a starting point. I'm still building on this portfolio. So whenever I buy, I will just buy into things that I own. So it's like keep on adding and adding and adding, right? So it's more like a systematic executions instead of like do like just keep on buying new things. What's your take on Warren Buffett selling 50% of their Apple holdings? Just profit taking? So I actually don't know why he's selling with that kind of magnitude. Okay, that's that kind of sizing. My sense is that maybe he's thinking that it's overvalued. That could be one. And of course, overvalue is not just, you have to look at the overall companies, right? If let's say me, right, I'm looking at Apple's financial, I think on margin front, they are stable, they are doing okay. But from growth perspective, that's the part that I think is like really, we can see that Apple is, their business, their core business, right, is really in those mature category. You don't see like 20, 30% kind of growth. If this is a company where their core business is already matured, they shouldn't command a very high PE multiple. And if you compare that, their current PE multiple definitely looks quite pricey. So I think he's really taking profit and buy something he prefer. I think that's That's my guess, but actually I don't have a high confidence that I know what he's doing here. We all just need to wait until, like when it comes to annual shareholder meeting, or maybe sometimes he appear on CNBC, do some interview. Maybe he will share a bit more on why he's taking profit on these positions. I really don't know. My sense is that it could be like just taking profit. Yes, I don't expect Apple to go back to 20 or 30%, 40% kind of growth level, but I think that this entire Apple intelligence, I do think that it's able to, like push more people to upgrade. I think there are quite a number of iPhone users that are just happy owning iPhone that is like 2 years, 3 years, 4 years old, right? I am using iPhone 11. We are now at 15, right? So it's already 4 years. So I'm still using it and still doing, I mean, the phone is it's great. So I'll be upgrading this September, but I'm thinking that there are quite a number of people they're happy. But once this Apple intelligence comes, right, so it's at least giving a good excuse to current owners to upgrade. They are doing okay for the upcoming 1, 2, or 3 years. And then after that, right, whether this company is a great buy or not, I think it really depends on whether they are able to turn all this Apple intelligence stuff, meaning that all the AI services, right, can they create services that is really, really good, and then they charge a fee on that, they monetize these things, so, and then it will become a great, like subscription business. So this is the part that I think there's further upside. And these are high margin business, by the way. They don't need a lot of like revenue growth. Their margin can just keep on trending up just because of all these services. And I think Apple usually they're quite good on these small things one. They are not great at like pull up a big project, suddenly go and sell car and so on. So they are not great at that. But for smaller things, right, like creating small AI services, they know what their customers want. They know how to create all these small things. This is why I like about Apple as well. Where do you get the charts from? Would love to see the source site. I will put it in the video description later. What's your take on investing into Tesla long term? Guys from Bagholders used to be quite bullish but seems to turn bearish now. Okay, I will say I agree with you. I think last time Kelvin used to be very bullish, but now we are all keep on making fun on Tesla. Even Eric also used to be bullish when he was still creating his YouTube videos, but now also turning bearish already. But actually, if you look at Tesla, right, okay, let's break down the period, okay? I think when we are all super bullish, that period, right? Maybe it's like, let's say 2021 period, right? That was when they are, like all the Tesla, even their resale car, right? It's like command super high price and like they are just busy about ramping up their car productions because every car just huge demand, and then they keep on selling. And after that period, right, I mean those are the period where you don't even need to look at their FSD. You just look at their car business. Their margins are trending up. Their growth is still going decently. Just looking at their car business is also like a very attractive business. Provided that they are able to like keep their pricing, they are able to keep growing at that kind of high growth rate, right? So that was one era. After that, what happened is that okay, they sort out the manufacturing stuff. They are able to like manufacture, and then suddenly I think all the other automakers also they sort out their all the supply chain problem, and then car prices actually dropped, right? Then interest rate also went up, and then you can see that it's really getting costly for buyers to buy cars. And we saw that Apple have to keep lowering their car prices just to make sure that all the cars that they manufacture is able to be sold. Okay, so what happened is that car prices keep dropping, the margin keep dropping because they adjusted down their price. And after like many quarters, right, you can see that this so-called high margin is no longer there. Okay, the car business go back to the normal, which is just a low margin business. Okay, so if you just split up, right? There's on the FSD side, there's the automaker side, right? The automaker side, right? I will agree that the financials looks very bad. Okay, I have to acknowledge that, right? Recognize that it's not great because the margin is low, the growth is low. Just because of all this price cut, the revenue growth also looks bad. So nothing to be excited about Tesla at this moment. If you're just looking at the the car business, then the question now is that what's the other part? The other part, we still have all the FSD, and for those who are still skeptical about the FSD, right? You just need to you go YouTube, go search Tesla FSD, and look at the the test drive experience, right? There's really clearly much improvement in the FSD technology compared to 1 year ago. Okay, so and all this, right? I don't think it will just like one flip of a switch. Suddenly they just pass level 4 and just run with it, right? I don't think that will be the case. What they try to achieve is that now, I don't know whether you all follow all these FSD things. If you follow, you will notice that just maybe like 1 year ago, maybe 2 years ago, when those Tesla bull keep on saying that, oh, FSD is soft and so on. Actually, back then, right, when they turn on the FSD, still they have to keep on re-engage back the FSD. Okay, but this like how long they have to drive to like take over the car, like the frequency of the engagement, right? You just track this frequency from like 2 years back until now, right? It's like getting better and better, meaning that the car ability to drive itself keep on improving. So, and these things is not like they improve then plateau already. And yes, sometimes it plateau and then they come up with some software or hardware fix and then they improve back again. So right now, I think that actually they are still in a nice trajectory of improvement. And I think that this part alone, there's some value to it, right? Because the moment these things become good enough to be, monetizable, they can monetize it, it become like a decent revenue stream with high margin. So I don't think we should, be so extreme about it, saying that, oh, FSD is something that they forever cannot solve. Even if they can't have like significant improvement over the next 6 months, then we just wait 1 year, right? If 1 year they don't have anything, like let's say the improvement is only 30%, then you wait another year. So it's improvement again. So this FSD technology, right, is something that it will only improve. And we don't know like the moment it become good enough to become like a huge revenue source, right? So that's why I would say that for me now, just need to balance my view between these two. One is that the auto maker business isn't that well. But of course, if it is bad now, doesn't mean it will stay bad, right? It might improve. Let's say, for example, interest rate really cut 100 basis points from now. Will it be, cheaper for people to, do a financing and buy a car? So I think that's something on the automaker side. But on the FSD side, I think they are improving. So I'm kind of like, having an exposure, just betting on the FSD side. Of course, if everything's turned out like this FSD keep on stuck at this level for 10 years, then this entire investment become like just idle money, not earning a decent profit, then I'm fine with that also, right? So we are all positioned according to our conviction level, and currently my conviction level is where my position is, which I show in the slides before. So I think that's my view on Tesla right now. Actually, the reason why we didn't make too much like coverage on Tesla is because for Bagholders topic, right? If we cover single company topic, it could be Tesla, it could be NVIDIA, and these are stocks that people talk about, and we don't get a lot of views. So that's why we don't tend to make too much single stocks analysis because of that. But let's say if you really want to hear us talking about all these companies, right? Maybe you just need to be a bit more noisy on Telegram group. Just mention to Kelvin, mention to Chicken and myself that you all want to see this kind of video. And then let's say if there's any news, right, we think it's worth to talk about it, to discuss about it, then we will bring it for discussion on Bagholders. Okay, from Chiwi. I think Elon Musk said don't invest in Tesla if you don't believe they will solve FSD. I think that's correct. Just the auto business, because there's interaction between these two, right? Say for example, there are quite a number of people actually they bought into Tesla car because of the FSD. So if you are saying that this FSD is something that you are bearish, you don't think it will work, you think it was just stuck at its current level, right? Then you also shouldn't expect that their car business will do well, because car buyers, there's no reason, or just not to say no reasons, to say the reason to buy Tesla isn't as strong, just because of EV. There are many other options as well, right? Tesla is, you buy it because EV and plus the FSD, right? So I think the FSD is actually quite important. Tesla energy business is also doing very well and growing to a sizable amount. I think that's correct. I do agree. But the question is how big it is now, because relatively speaking, if you compare the auto business versus the energy, the auto business is still the dominant one. Okay. From Carl, have you ever considered looking into micro cap stocks? I know that Buffett says that that's the best chance to make huge gains with small amount of money. I think yes, micro cap. Let's say if a company is, let's say, 1 billion market cap, and you think that you know the companies, and you think that there's huge upside, right? Of course, it's a lot easier from 1 billion market cap to grow to 3 billion, right? So definitely easier to find multi-bagger in micro cap or small cap, right? But when I look at all these businesses, sometimes it's not saying that they are bad. It's just that I struggle to know what, struggle to see the reason why their quality is like super good. Because I think this is not to say that they are all bad. It's more to say that when I look at companies, right, the things that I pay attention to are usually the characteristic of a large company. Say for example, right, I bought into Amazon. Just now we talked about Amazon, right? I like businesses that, you know, that they are having all these like platform, okay? They own their platforms. They determines the rules of the platform. And I like businesses that have scale. Okay, for example, like Amazon, because they already built out their logistic, they already built out all this, relationship with their partners and so on. So it's already the skill that's running well already. So I do see this as a quality that I like. And this kind of companies is small cap. You don't see they have this kind of skill. So it's just a matter of preference. So let's say if you like the video, please give a like and subscribe to the channel. Thank you for tuning in, and see you in the next video. Bye bye.